Okay, this is M7-6, which is on page 332 in your textbook. 7.6 says, given the following information, calculate cost of goods available for sale in ending inventory, then sales, cost of goods sold, and gross profit under FIFO, LIFO, and weighted average. We're going to assume that a periodic inventory system is used. So if you'll recall from your reading, periodic inventory system just means that we're only kind of reconciling our inventory numbers at the end of the period. We're not keeping a running total of those inventory costs during the period. So we're going to calculate a whole bunch of things under those three different inventory costing methods. We might as well start with letter A, which is FIFO. If we recall from the reading again, FIFO means first in, first out. So that means the oldest inventory units we have are the ones that we are assuming we kind of sell first, right? The first in to the pile, the first out in a sale. So we're also told that on July 1st, we had beginning inventory 50 units at a cost of $10. On July 13th, we purchased 250 units at a cost of $13 each. On July 25th, we sold 100 units, and that means in inventory, ending inventory, we have 200 units left. So under FIFO, first in, first out, let's take a look first at the units we've sold here. Again, we had 50 units to start the month, and we had 250 units that we purchased on July 13th. So under FIFO, the 100 units we sold on July 25th are going to be the 100 oldest units we have. So if we look in order, we've kind of laid them out in order here. That means we're going to assume that we sold 50 of those beginning inventory units at a cost of $10. And I'll just add some headers here for us. And we also sold another 50 units to get to our total of 100. Those would have come from the 250 that we purchased on July 13th. So those have a cost of $13 per unit. Okay, so our total sold units here, 100. Total cost, we can figure that out pretty quick. 50 times 10, the oldest, plus the 50 times 13, the second oldest. And we'll just add those together, 500 plus the 650. So our cost of goods sold for July is $1,150 under FIFO. We also need to calculate cost of goods available for sale. This will be the same under all the inventory costing methods actually. So cost of goods available for sale. If you recall, that's just the total cost of goods, as the name implies, that we have available for sale during that given period. So that's the 50 units at 10 that we started with, plus the 250 that we purchased at $13, for a total of 300 units and a total cost here of $3,750. And again, this was units, cost, and then total cost. So we've got our cost of goods sold, we've got our cost of goods available for sale. Now we're looking for gross profit. Well, gross profit is sales minus cost of goods sold. So our cost of goods sold we just determined was $11.50 here under FIFO. Our sales, we only made one sale. That was on July 25th when we sold 100 units at $15 for total sales of $1,500. So that leaves our gross profit at $350. That's just, again, the total sales, $1,500, minus that cost of goods sold number. We're also looking for ending inventory here. So I'm going to do this over to the side. We were told that we have 200 units in ending inventory, and we just need to determine the cost. Well, there's a few different ways we can do this. Given the other information we've calculated, we can actually back into it. Our cost of goods available for sale less our cost of goods sold would in fact be our ending inventory, right? We're just saying there, well, my total goods available for sale minus what I sold would be what I have left over. Okay. So cost of goods available for sale we just determined was $3,750. My cost of goods sold under FIFO here is $1,150. So my ending inventory is the difference between those two, or $2,600. And again, that was 200 units we had left. The other way we could do that is to do what we did here with cost of goods sold, but work in reverse. Right? If I sold my oldest units, then the ones I had in ending inventory were my newest. So given that I have 200 units in ending inventory, those 200 units are going to be my newest 200 units. Well, if we back up our list here, our last purchase on July 13th was 250 units at $13. So my newest 200 units are 200 at $13. And incidentally, of course, that's also $2,600, which is the number we just came up with for ending inventory. I know there were a lot of moving pieces there, so if you need to, stop and back up and watch this part again. And then I'm going to do the same thing for LIFO and weighted average. Okay, continuing on, we're going to calculate those same items using the LIFO method. So LIFO, again, last in, first out. It means that we assume the newest inventory items in our pile are the first ones leaving the door. So it's important to note first here that the cost of goods available for sale, that would be the same under all of our inventory costing methods here. So cost of goods available, we had 50 that we started with at $10. We had 250 that we purchased at $13. A total of 300 units and a total cost of $37.50. So let's determine the cost of goods sold. Let's figure out what we sold here. So LIFO, last in, first out, means that the units we sold, again, are going to be the most recently acquired units. That's what we're assuming. So I sold 100 units on July the 25th. Means I need to find the most recently acquired units prior to that date. If I back up just one line here, on July the 13th, I purchased 250 units. So I can assume that all 100 units I sold came from that batch, if you will. Those had a unit cost of $13, so the total cost just $1,300. Okay, so again, that's cost of goods sold. I can determine the ending inventory in one of two ways, just as I did with FIFO. I can back into it by taking my cost of goods, available for sale, which we were already figured was $37.50, less my cost of goods sold of $1,300, and that means my ending inventory, the difference between those two, $37.50 minus $1,300, is $24.50. I can also keep track on a unit basis, similar to what I did to determine cost of goods sold. I just work in reverse. Last in, first out says I assume that I sold my most recent units, which means what I have left are going to be my oldest units. So if I determine my oldest units here, I'd say, well, I've got 200 units left in total. That means that my oldest units were my beginning inventory, 50 at $10. So beginning 50 at $10, total cost $500. I also would have had 150 other units. I'll just put other here. Those would have come from my next oldest units. Well, the only other batch I have to pick from is that purchase on July 13th. So those 150 units must have been 150 at a cost of $13 each, for a total of $19.50. And there's my total of $24.50, and that matches the number I came up with over here. So either method is fine. You're going to get to the same answer. We also need to calculate gross profit. So gross profit, as we determined previously, just our total sales. In this case, that was the $1,500. Less my cost of goods sold. In this case, that's $1,300. For a gross profit of the difference, or $200. So that takes care of LIFO. And now we need to move on to the weighted average method. Okay, last but not least, we have weighted average. Weighted average, as you recall, means we literally take a weighted average of our cost of inventory items and base all of our resultant calculations on that average. So we might as well point out that our cost of goods available for sale is once again $30,750. That doesn't change under any of our methods in a periodic system. Now let's determine our cost of goods sold. So the first thing we need to do is come up with the weighted average cost of each unit of inventory. We're going to use our cost of goods available for sale to make that determination. So we had 300 total units that we could sell during the period. They had a total cost of $3,750. So we're going to find the average cost of each unit. So that's the total cost, $3,750, divided by the number of units, 300. And that's a weighted average cost of $12.50. I'll just put per unit. So our cost of goods sold, we had a total of 100 units sold. Again, that was on July 25th. Our unit cost is our weighted average unit cost of $12.50, which means our total cost is just those 100 units times the weighted average cost per unit, $1,250. Now again, ending inventory we can determine in one of two ways. We can take our cost of goods available, again that's the $37.50, less our cost of goods sold of $12.50 to get our ending inventory of $2,500. That $2,500 is just the $37.50 minus the $12.50. We could also get to it the same way as we did with the FIFO method a moment ago, and take the 200 units we have in ending inventory and multiply that by our weighted average unit cost of $12.50. As you can see, we get the same $2,500. Okay, always get to the same answer, assuming you've done it correctly. This doesn't necessarily matter which method you use. Sometimes you may not have enough information to work through this way. You may need to do it that second way. So we've calculated our cost of goods sold, our cost of goods available, and our ending inventory. Now we need to determine our gross profit. So our sales, still just the $1,500, less our cost of goods sold of $1,250, means our gross profit under the weighted average method is $250. The $1,500 sales minus the $12.50 in cost of goods sold. Okay, so as you can see, we get different numbers for gross profit, which is an income statement subtotal. We get different balance sheet amounts for ending inventory depending on which costing method we used. If you need to back up and watch any of those again, please do so. And of course, as always, let me know if you have any other questions. Okay, we are looking at M7-12 from your textbook, which says, use the information in 711, prepare journal entries to record the inventory transactions, assuming Anderson's uses a perpetual inventory system. So when we look back up to 711 right above it, that tells us that assume Anderson's General Store bought on credit a truckload of merchandise from American Wholesaling costing $23,000. If the company was charged $650 in transportation costs by National Trucking, immediately return goods to American Wholesale costing $1,200 and then took advantage of American Wholesaling's 210 and 30 purchase discount, how much did this inventory cost Anderson's? So we're worried about booking the journal entries for that whole mess. So let's break it down piece by piece here. The first thing that happens is that Anderson's bought on credit a truckload of merchandise from American costing $23,000. So we'll stop right there. We'll just mark that letter A. Purchased inventory costing $23,000 on account. So I've increased my merchandise inventory account. That's an asset account. So I'm increasing that with a debit, $23,000. I didn't pay any cash yet. Purchased it on credit. So we got to book some accounts payable. Any payable is a liability. Increasing that with a credit. Same $23,000. Nothing happens on my income statement. On my balance sheet, my assets and my liabilities increase, and there's no cash flow effect. So that's the purchase of the inventory. What happened next? Well, it says the company was charged $650 in transportation costs by National Trucking. Well, if you recall from your reading, any costs associated with our inventory in terms of delivery, setup, and so on, we call those inventoriable costs, and we add those costs to inventory. We do not expense them separately. So what I do is I increase the cost of my inventory account, by that $650 transportation cost, and I'm going to credit here, well, we'll just call it cash. Let's say we paid the trucking company in cash. Bottom line, the most important part is that I'm adding that cost to my inventory. Nothing happens on my income statement. On my balance sheet, my assets here have moved up and down, and I do have a cash flow effect. We'll call that an operating activity. The other alternative would be to book a credit here to accounts payable if I hadn't paid the trucking company yet. That would change our liabilities, but would not change what we did here to inventory. Next up, it said we immediately returned $1,200 in goods to American Wholesaling. So what we're doing here is saying, well, I don't owe American Wholesaling $1,200 for these goods I'm returning, and I don't have them in my inventory anymore. So I'm going to decrease my accounts payable account for $1,200. Okay, I'm saying I owe them $1,200 less than I did, and I'm going to decrease my inventory account to reflect that I no longer have those goods available for sale here. So a credit to inventory for that same $1,200. Now still nothing's happening on my income statement. On my balance sheet, my assets and liabilities have decreased, so I'm still in balance. Finally, it says we took advantage of American Wholesaling's 210 and 30 purchase discount, and we paid them off in full. So if we think back to our credit terms, 210 and 30 means we get a 2% discount within 10 days, and the balance is due within 30. So now we're paying them in full. So what's happening? Well, we're getting rid of our liability to the wholesaler in total. So I need to decrease my accounts payable account. Be careful with your amount here, though. We owed them $23,000 originally, but we returned $1,200 worth of goods a moment ago. So really what I owed them and what I'm getting rid of in terms of an obligation is $21,800. Again, that's the $23,000, the original purchase amount, minus the $1,200 return we did a moment ago. Okay, so I have a debit so far of $21,800. I'm paying them off in cash, so let's go ahead and decrease our cash account. Again, be careful with our amount here. I owed them $21,800, but I'm not paying them $21,800. I'm paying them 2% less than that. So I can say, well, $21,800 minus 2% of 21,800 or 98% of 21,800, same thing, is 21,364. That's what I'm actually paying them in cash. Now the difference between the 21,800 and the 21,364 is that 2% discount of 436. Okay, I book that. That's a reduction to my merchandise inventory cost. I'm literally saying my inventory cost $436 less than what's sitting on the books because I took advantage of that purchase discount. I don't expense anything here. I don't use any contra account like I do with my sales discounts. I take that cost directly off the inventory cost. And again, that 436 is the 2% discount on the $21,800 that I owed them. Still nothing happens to my income statement. Okay, nothing happens until I sell those goods. On the balance sheet, my assets have decreased. My liabilities have decreased. And I do have a cash flow here, an operating outflow of the 21,364. So that's all we needed to determine for 7-12 here. Okay, this is M7-16. So that says refer to M77, which is on the previous page. We're going to calculate the cost of ending inventory and cost of goods sold, assuming a perpetual inventory system is used in combination with either FIFO or LIFO. We'll do both. So if we flip back to 7.7, we see a bunch of purchases and sales of inventory in that yellow box. So the format I'm using here on your screen is the little inventory ledger that I've posted in Blackboard. You may find it helpful in terms of keeping track of these things. They can get pretty messy, especially when we have a whole bunch of sales, a whole bunch of purchases, and we're using that perpetual system, trying to keep track throughout the period. So I'm going to work through LIFO first here. Okay, so I'm just going to mark LIFO so we can kind of keep track. So the first thing that happened is on July the 1st, we had beginning inventory 2,000 units at a unit cost of $40, and we'll get our total cost by multiplying those two out. Okay, so this ledger, again, we're just trying to give ourselves a little bit cleaner way to keep track of all these moving parts. The three main sections here are the cost of goods purchased, so we're going to add purchases in these three columns: quantity, unit cost, and total cost. For any sales, we'll keep track in these three columns here in the same way. And then we'll always keep track of our balance, and this will help us separate out kind of the age of our items. So I'll skip lines too to make this a little easier to read. On July the 5th, we sold 1,000 units. Okay, so I know I sold 1,000 units. LIFO, last in, first out, means I am assuming I sold my most recently acquired units. Well, in this case, I only have one batch to pick from anyway, right? This beginning inventory. So I assume that those 1,000 came from these at a cost of $40 each. And there's my total of 40,000. Now, once I've sold those, I need to keep track of my ending balance or my interim balance. I had 2,000 units, I sold 1,000, so I've got 1,000 left. Again, we're costing them at $40, and there's my $40,000 total cost. So far, not too bad. On July the 13th, I purchased 6,000 units at a cost of $44. So that's a total cost here of $264,000. Nothing sold on this date. So now here's where this balance will help us out. List them in order, don't combine them, keep them separate. So I had my original or my oldest 1,000 units at $40. That's coming from this right here. And now I've also got 6,000 units at $44. Okay, so I'm highlighting these two rows. This is my balance as of July the 13th. I have 7,000 total units, but I want to keep them separate from a costing standpoint so I can keep track of which ones I assume are getting sold. So now on July the 17th, we sold 3,000 units. Okay, 3,000 units. So last in, first out, again, means my most recent items are the ones I'm assuming are leaving. So I need 3,000. I can take them all from that recent purchase on July the 13th. Those are my most recently acquired units. So I say, well, I'm assuming I sold 3,000 at a cost of 44. Total cost, 132,000. So now what do I have left? Well, I still have the 1,000 at 40. Those are my oldest ones. I didn't touch them with this sale. And I have 3,000 of the 6,000 most recently acquired units. Okay. So again, this was what I had as of July 13th, 1,000 units at 40, 6,000 at 44. When I sell 3,000 on the 17th, I assume they came from my most recently acquired units, the 6,000 here. So I've chopped that in half. I still have the 1,000 oldest units at 40 and 3,000 of those units at 44. So now this is what I have currently in inventory. Next up, we purchased on July the 25th 8,000 units at $50 for a total there of 400,000. So now I have the 1,000 at 40. I still have the 3,000 at 44, just moving these down, and I have 8,000 at 50. So in terms of costing, I have three kind of batches to think about. Some at 40, some at 44, some at 50. One more transaction, July the 27th. Here I sold 5,000 units. So again, using LIFO, last in, first out, we want my most recently acquired units. Well, since I've kept these in order, it's easy to see my most recently acquired units are the 8,000 at 50. So I say, well, I assume I sold 5,000 of those at $50. Total cost of 250,000. Now what do I have left? Well, I've got the 1,000 at 40 that I never touched. I've got 3,000 at 44 that I didn't touch with this sale. And of this 8,000, I got rid of 5. So I've got 3,000 left at 50. Okay. Now I'm looking for my ending inventory from a cost standpoint. So to get that, all I need to do is total up what I've got here. So my total inventory cost at the end of the period is the sum of the 40,000 plus the 132 plus the 150, or 322,000. To come up with my cost of goods sold, I can just total up, another handy side feature of this little ledger, all of the total costs from my sold column in this spreadsheet. Okay, so that's, if I scroll up, the 40,000 here, plus the 132 here, plus that 250 on July the 27th. Total cost of goods sold, 422. Okay, again, this was ending inventory of 322. Back up and watch and work through this again if you need to. And then I'm going to do the same thing for FIFO. We'll see how they differ. Okay, so we're continuing on now with the FIFO version of 7-16 here. So our beginning inventory is the same as it was under LIFO. 2,000 units at $40, total cost of $80,000. On July the 5th, this transaction is the same as well. We sold 1,000 units. Now this could be different given that we're working under FIFO instead of LIFO, except here we only had one kind of batch to pick from anyway. This 2,000 at 40. So the 1,000 we sell here, we're assuming that those are at 40 as well, for a total cost of 40,000. Now what we've got left is the other 1,000 at 40 for 40,000. So far no real big difference for us. On July the 13th, we purchased 6,000 units at $44. So we'll do the math out there real quick. 264,000. Now again, for our balance, make sure we keep track of them on separate lines to help ourselves out later. We had the 1,000 at 40, and now we've got the 6,000 newer units at 44. And there's our balance in total. On July the 17th now, we sold 3,000 units. So FIFO, first in, first out, means I assume I sold my oldest units, and I need 3,000 total. So my oldest in order are the 1,000 at 40 here, so those are all gone now. And I still need, whoops, missed a zero. I still need another 2,000 units to get my total of 3,000 sold. So 2,000 have to come from this only other group we have at $44. Total cost 88. And now what do I have left? Well, I've gotten rid of all of the units at 40 and 2,000 of the units at 44. So 6,000 minus 2,000. I have 4,000 units at 44. Total cost 176. And I can move on. Again, working under FIFO here. On July the 25th, I purchased 8,000 at $50. So that was a total of 400,000. Again, what do I have as a balance? Well, I've got the 4,000 at 44. And now I have my newer 8,000 at 50. So there's what I have. Now on July the 27th, I sold 5,000 units. First in, first out, I need my oldest 5,000. Well, my oldest period are the 4,000 at 44. So I assume that I'm taking all of those. And I still need another 1,000 because I sold 5,000 total. So those must have come from this group of 8,000 at 50. So 50 times the 1,000 or 50,000. And what do I have left? Well, I've gotten rid of all these, the 4,000 at 44, and I've gotten rid of 1,000 at 50. So I have 7,000 left at 50. Total cost 350,000. Again, 8,000 at 50 minus the 1,000 at 50 means I'm left with 7,000 at 50. So my ending inventory is just what I have highlighted there. 7,000 units at a cost of 50 for a total cost of 350,000. A little bit different than my ending inventory under LIFO. Again, to find my cost of goods sold, I can just total up all of the dollar amounts from this total cost column. Just one handy thing about this little template. And I get a total of 394,000. Again, a bit different than under my LIFO method. And that's it for 7-16.